everyone, good evening and welcome to this tax special today on The Money Show. Today we're going to discuss a lot of topics including how to overall get expert advice on tax planning. Do you need to file your tax if TDS is paid? The implications of LTCG, as well as what happens if you've been irregular with filing your income tax returns. Our lines are open, so I encourage all of you, if you want free advice, please dial into the number at the bottom of your screen, or you can simply email us on themoneyshow@etnow.tv or connect with us on Twitter. Well, let's bring on board our expert who is going to guide us over the next half hour. And joining in today on the show, we have with us Ved Jain, former ICAI president. Good evening and thank you so much, Mr. Jain, for joining in. So much to discuss on the show, but let's just start off with the basics. When it comes to filing income tax returns, and often it's a task that's completed a bit mechanically, but what are the basics, do's and don'ts? Investing a little time and thought can really help a lot of investors out there to claim deductions that they might have failed to do so while submitting their investment declarations. So just walk us through the new ITR form and what are the exact details.
I see the first thing, the taxpayer need to make sure that he collects all the data which is required for filing the tax returns. And then he chooses the right form for filing the return. And it need to be filed well before the time, that is the 31st July 2018. So now the filing of tax return has been simplified because it is an MyLA's online filing. And as I see, there are three forms which are basically applicable to individuals. So in case you happen to be a salaried employee and you have not more than one house property and you have income from interest, etc., and if you are not carrying on any business, etc., the best form suited to you is ITR 1, which is a SEHS form, where you are required to give in the detail of your employer, detail about your one house property, and detail about your interest, income, etc. Now, coming to the need which you need to make sure and what precaution you need to take care of it, because now the return is computerized and all the information about you, whatever the transaction you have entered into during the year, are available with the tax department. So you need to make sure that you do not miss out any point, and so that there is a notice or there is a further clarification notice from the department. And for that purpose, if you happen to be a salaried employee, you get a form 16 from your employer regarding your salary, whatever the deduction is available therein. And then there is a form which is form attached to that, which gives you about the perks also and how those perks have been valued by your employer. Make sure that you go through those details and you fill in the form exactly the same detail which are available therein. The next thing is that you must go through your bank account, because every person by and large have the bank account, and there is a saving account that you get some interest, then you have some investment by your fixed deposit, etc. You get that also. If you have made investment in mutual fund, you have encashed some mutual fund, you hold some equity shares which have been sold out, you make an investment in PF or PPF where you get some exempt income, etc. So you get hold of all those information which is required to be filled in now. And you should not miss out, because all this income need to be disclosed, whether taxable or non-taxable. Like interest on PPF, which is exempt, need to be disclosed. Interest on saving bank account, which is exempt up to 10,000 rupees, need to be disclosed. Similarly, if you have interest on fixed deposit, which is chargeable to tax, it is not exempt, except in the case of a senior citizen whose income up to 50,000 is exempt, need to be disclosed. All these information is also available on the website of the Income Tax Department, which is Form 26AS, where detailed about your salary which you have received from the employer, the tax which he has deducted, the interest which you have received from the bank, the interest which you have received on your investment, all is available in 26AS. You need to make sure that you go through that detail and you reconcile and compile and fill in the written form. Similarly, there is an AIR, or what we call Annual Information Report, about the various transactions which you have carried out, whether you have purchased a vehicle, whether you have purchased a immovable property more than rupees 30 lakh, whether you have made investment in mutual fund, whether you have bought equity share, or whether you have foreign travel, etc., is also available in the AIR. So make sure that that information on basis in the return you are filing, you do fill in all those details. Then you make sure that now the written form mandate all your bank account other than the dormant bank account need to be disclosed. This is a statutory requirement under the law now, that all your bank account wherever you are having need to be disclosed. So please make sure that you disclose all those bank accounts. And in case you happen to have some refund, etc., please tick the bank account in which you want that your refund should be credited or sent by the tax department. These are the basics, I will see, the requirement which one need to make sure when filing the return. And please compile all the data from the 1st April to 31st March. Ensure that all income is correctly reported, all exemptions which are available are taken care of. At the same time, please don't get tempted to take an exemption or deduction which is not permissible in the law. Now it is a computerized word. The moment you claim, it will be disallowed and you can run into difficulties.
Okay, so we'll discuss that as well in greater detail, but those are the basic tips for filing your income tax returns. So Jain, we have some live callers as well, and since you're with us on the show, let's get straight to it. We have a live caller from New Delhi. Yogi Chopra is joining in. Hi Yogi, welcome to the show. Tell us, what is your tax grievance? What would you like to know from Mr. Ved Jain?
Hi, good evening. Good evening, Mr. Jain. So my question is regarding property tax. The question is, can you hear me? Sorry.
Loud and clear. Go ahead.
Okay, great. So my mother owns a property in Delhi, and we would want to sell it off. Eventually, we will. And we don't want to purchase another property in the coming years. And we just want to keep the money liquid. And it's been 5 years that we have this property right now. The question is, are we liable to pay any tax to the government later on, or so how many years can we hold the money liquid with ourselves? How does it work?
Would you like to help him out with that question? He owns a property, as of now wants to keep that money liquid. So is he liable to pay any tax until and unless he looks for a new property, which could take time, he specified?
So what I understand, Avan, is that the mother is owning a property which is more than 5 years old. So whatever, she would have purchased a property for, let's say, X amount, and now she is going to get a Y amount on the sale of the property. The difference between Y and the X amount will be the capital gain in her hands. And since the property is more than 2 years old, now she will be entitled to have the benefit of an indexation and a concession rate of 20% tax. Now, in that way, if she has purchased a property 5 years back at, say, 10 lakh rupees, and then after looking to the cost inflation index of the year in which she has purchased and the cost inflation index of the present year, so that index cost will be increased. So 10 lakh will become, say, 15 lakh rupees. And if she is selling this property for, say, 25 lakh rupees, on a difference of 25 and 15, she is required to pay tax at the rate of 20%. And thereafter, she is free to use the money the way she wants. In case she buys another property, house property, then the exemption is there. But the caller has told that mother is not interested in buying any property, the liquid she wants to retain. So she need to pay 20% tax on the difference of the sale realization minus the index cost of acquisition, since the property is a long-term capital asset, and on that 20% tax need to be paid, and she is free absolutely thereon.
I hope, Yogi, we were able to answer your question and you've got a little more clarity on this funds that will be liquid and what the exact tax implications are. Thanks very much for connecting with us. I believe we have another live caller with us. Can we connect with Akbar Ali from Mumbai, who is joining in on the phone line? Hi there. What's your question? Thank you for connecting with us on the tax special. Mr. Ali, can you hear me?
Ma'am, my name is Ravindran Ramchandra.
Oh, Rabindranath, is that, okay. Sir, go ahead with your question.
Can I go ahead?
Yes, sir, go ahead.
Yeah. See, I'm a retired person.
Okay.
I don't have any other income or pension, but I have a certain income from the share market by selling and buying and selling shares. So by doing that, I incur some capital gain. Do I have to file a return for this type of income?
Purely dabbling in the stock markets right now, what is the advice, Mr. Jain?
Yeah.
Mr. I think you are a retired person and you are having income. See, the law mandate that every person, every individual who is having income more than the income which is not chargeable to tax, the present threshold being like 2,50,000 rupees, so you need to file the tax returns. So in case your income from the share, I will not say that your income is coming from by way of investment, as you have told that you are buying and selling share, so probably you are doing trading in share rather than doing investment in share. If you are a long-term investor, if you are making investment and then selling it off, that's a separate issue. But as I consider that you are trading in share and in your income during the year, in a financial year, is more than 2,50,000 rupees, then you are duty bound to file the tax return and pay the tax thereon. The tax rate will be 5% from 2,50,000 to 5 lakh rupees, and then of course 20% on income above rupees 5 lakhs.
I hope it's crystal clear. Income, at the basic limit of 2,50,000, it is mandatory to file your income tax returns if it is above this amount a year. Do call in to the number that's flashing on your screens if you have any tax-related questions. We have Mr. Ved Jain with us through the course of this show. Well, let's take on board our email query from Sumant Hengde. He says, I own 2 residential apartments, one in Mumbai where I stay and the other in Delhi, which has been put out on rent. I plan to sell the Delhi flat and buy 2 residential units for my sons in Agra and Noida. Will I have to pay tax on the sale is what he is asking. If you could just clarify for him under which sections he can claim exemptions, etc., and what is the way forward for him, Mr. Jain.
Awan, as I understand from the facts, this gentleman is having 2 property, one in Mumbai and one in Delhi, and the Delhi property which he is holding is more than 3 years old. If that be so, then he can sell this property and buy another property, and then capital gain is exempt. But for this, under section 54, there is a condition that you can buy only 1 property. Since he is buying 2 property, so exemption will be available to the extent of the value of the new property, 1 property which he has purchased. I can just correlate with an example. Suppose the Delhi property which he has bought some 5-10 years back for again say 10 lakh rupees, and now this property is being sold say for 50 lakh rupees, and today the index cost of the acquisition of that property say 10 lakh has become 15 lakh, then 35 lakh is the capital gain in his hand for a long-term purposes. If he uses this 35 lakh rupees for the purchase of 1 property, to that extent that capital gain will be exempt. Now in the example, he is trying to buy 2 property, and in case 1 property is for 20 lakh and another is for 15 lakh, he will be entitled to claim exemption of 1 property or 20 lakh rupees, and on balance 15 lakh rupees he will be required to pay tax at the rate of 20%. As I understand, the gentleman is maybe want to settle the 2 sons and want to give 1 flat each to both the sons or both the children. If that be case, if he does in the manner in which he has proposed, then he will be liable to pay tax on the 15 lakh rupees. In case he want to avoid this and plan it out, the best way will be that before he is selling that property in Delhi, he gives this property 1/2 each to each of the son. So 1/2 owner of the Delhi property become the son, 1 son, and another become 1/2. And then the son in turn sells this property to outsider, and the money which they get, each one of them, then they buy out the property, each flat of them. Then the capital gain will be fully exempt, because each son will be eligible to claim exemption under section 54, which the father will be claiming otherwise. The father can claim 1 exemption, the son each one will be able to claim the exemption, and both son will have the benefit of the capital cost or index cost of acquisition of the property which the gentleman has bought. I believe this will clarify the issue of the gentleman which he has asked this question.
It certainly will. I hope we helped you out with your question. Thanks for intricately, spelling it out for him as to what should be the next course of action. On that note, we slip into a quick commercial break. If you have any tax-related questions, there's a number that's flashing on your screens. Mr. Ved Jain is with us. Stay tuned. Welcome back. Thanks so much for joining in. This is the Tax Special on the Money Show. We're discussing lots of topics on how you can, save your tax returns, the right way to save TDS, and lots more. We have Mr. Ved Jain, former ICAI president, with us on the show. And Mr. Jain, our phone lines are going absolutely abuzz. Let's connect with Mr. Jaikumar from Pune, who is with us on the phone line. Welcome to the show, Mr. Jaikumar. How can we help you? What's your question?
Good evening, both of you.
Good evening.
Thanks for answering my call. I have a question. In March 2018, I resigned from my job due to personal reasons. My last date was 21st March 2018, and as per agreed terms and appointment date, the company deducted 3 months notice pay. But the final settlement, everything happened or rather took place in April 2018. So can I claim my notice pay deduction plus because of reverse charge mechanism, company has charged me GST also on that notice pay. So can I claim that in my March 2018 income tax return?
Okay. Mr. Ved, what is the advice that you have for him?
Mr. Jai Kumar, unfortunately, the law does not mandate it. Salary income is to be computed on the accrual basis or receipt basis, whichever is earlier. So whatever income has accrued to you by way of salary from April to March 2018, so April 18 deduction cannot be claimed in that year. So it's not possible. And you will see that your Form 16, the employer would have also not given you the deduction of that amount. So the law mandates salary income is to be computed in a particular manner, and you will not be eligible to claim that deduction for the financial year 17-18.
You cannot claim that deduction, but I hope you got some clarity nonetheless, Mr. Jayakumar. And do remember to keep your questions coming, even if it's tax related, on the Money Show at etnow.tv. We will get them answered every Tuesday on our tax special. Deepak Raut, meantime, is also joining in from Pune with a question for Mr. Jain. Welcome to the show, Deepak. Tell us, what's your question?
Yeah, recently I joined one organization and I have fixed salary of 18 lakhs. And my question is, apart from this salary, I am also doing share trading, so daily basis. So I want to know in how much can I apply for the tax benefits?
Also, apart from working, you're also doing, I'm sorry, I didn't catch that.
Apart from working, I'm share trading, study shares. So investment, so I get sometimes losses, I get some profit also. So what do the get benefits?
If you've understood that question, Mr. Jain, how would you like to reach out to Mr. Raut?
What I understand, Mr. Rao's question, what I have understood is that he is getting a salary income, and he is simultaneously doing some share trading where he has suffered some losses. I believe that's an issue which is there. In case there is a profit from the share trading, there is no issue. You need to add to your salary income and pay taxes on both of the income. But the law says in case you are doing share trading and you have suffered any losses, that loss is not eligible for set off against the salary income. Now, business losses cannot be set off against salary income, and that's why this share trading loss will not be eligible for set off against salary income. You can carry it forward for the subsequent year and claim this deduction when you have a income from share trading in future. So, but you will not be eligible to set off this share loss against your salary income so as to reduce your liability of tax on your salary income.
Thanks for connecting with us, Mr. Raut. I hope your question was answered. Next up, we have an email query from Pratap. He says, I have been working for an MNC for 6 years, and all these years I have filed for TDS. However, I've been irregular in filing my returns. Also, at times I fail to pay tax on my other income, such as interest income. What is the time frame, he asks, within which the IT department can audit my financials or question me? So here, Pratap is talking about, admitting to the fact that he's been very irregular in filing his returns, not even paid tax on some of his other income. I'm sure there are other people who are in the similar boat. First, Mr. Jain, I want you to tell us, how important it is to be regular. And second of all, of course, his question is, what is the time frame within which the IT department can audit my financials?
See, let me clarify this, gentleman, that filing of return to be regular is very, very important, and the law has been recently amended. In case one does not file the return at the before the due date, then one can be penalized with a penalty of ₹5,000 if the return is filed by 31st December. But if the return is not filed by 31st December, then the penalty can be of ₹10,000. Further, in case the return gets delayed beyond the end of the assessment year, that is the current return which is not filed before 31st March 2019, then beside this penalty, one can be prosecuted and there can be a prosecution and imprisonment on that account also. So one need to make sure that the return is filed regularly and it is filed in time and it is filed correctly. Now the second question is that why he has not filed the return correctly and some of the interest income or the other income which he has been earning has not been disclosed. I believe this is a serious matter on that issue. As I said earlier, with the computerization having taken place, all the income which one person individual is earning by and large is within the knowledge of the tax department. Tax department collects so much information by way of tax deduction return, by way of annual information return, by way of other intelligence working, banking institution, etc. All your transactions are within the knowledge of the tax department. So I will suggest that nobody should get encouraged to avoid paying taxes on the return. But I must say that saving bank interest up to rupees 10,000 is exempt. So, but one need to disclose and then claim an exemption. So in this case, I believe this gentleman was having some income from saving bank interest. If it is up to rupees 10,000, so then it will be exempt. But in case it was beyond, then he need to pay taxes. Now the third question was up to which year the department can reopen the assessment and can get hold of the person. So law as on that says that department can reopen the assessment up to 6 years from the end of the assessment year. So today also, if any person has earned any income in the financial year 2011-12, which is assessment year 12-13, the income tax department can reopen the assessment, making an allegation that your income has escaped assessment and you have not filed the return correctly. If that happens, then the person will, in addition to pay the tax and the interest, will also be liable for paying penalty of concealment, and this gentleman can also be prosecuted for filing wrong return. So I will not suggest anybody to not to file the correct return. One should file the return correctly. The fourth question is what the person should do right now, what he has done and landed himself into a difficulty. I will suggest that the return for the assessment year 17-18, that is the last financial year 16-17, can still be revised because the period is 1 year from the end of the assessment year. So he should immediately file that return, revising the return, pay the taxes accordingly. In case of other income which he has escaped, which he has not filed, I will suggest he can just write a letter and pay taxes and then file the return after getting a notice from the department.
Okay, so file those returns which you haven't after getting a notice, but make sure you are regular. Mr. Jain, what a pleasure it's been. Thank you so much for joining in today and helping out all of our viewers. Every Tuesday is the tax special. If you have queries, email us on The Money Show at etnow.tv. Thanks for watching.